Hi, this is Martin Andelman from Andelman Matters, and this is a Andelman Matters video podcast. Maybe we should call it a vodcast. In any case, I'm here in Washington, D.C., and I wanted to talk to you again about the economy, where things are headed, what it looks like today, and I thought, what better place to do it than here, right? Well, if you recognize that big, giant building behind me, you guessed it right, that is the Federal Reserve. Or maybe we should just start calling it the money store. So where are things economically speaking? Well, just like last time around during the Great Recession that started in 2008, the media is not talking about it much. I mean, for a long time now, we've been hearing things like, well, it's a temporary shutdown, it's going to be a V-shaped recovery, it's all going to bounce back as soon as the virus gets under control. But that seems to be kind of naive at this point. It really does. We've got 44 million people on unemployment. The numbers continue to go up. And the CARES Act, which is the bill that Congress passed to help alleviate some of the economic pain caused by the shutdown of the economy, really starts to run out at the end of July. The extended unemployment benefits look like they could run out. We don't know if there'll be a replacement or not. But the reality is people are hurting a lot more than it seems they are, because of those economic stimulus packages. For example, we had some decent retail numbers in May, obviously, because things started to open up and people went out and spent some money. But now they're debating whether the economy is going to contract by 30% this quarter instead of 40% this quarter. Either number is a horrific number, right? It's too much. And now we are talking about which jobs aren't going to come back. And there's all different estimates for this, but I've seen low estimates. They say 28% of the jobs won't return. I've seen higher estimates that go up to 70. I don't know which one is true, but neither one is particularly reassuring. So here's how the CARES Act was set up. It was set up to provide extended unemployment benefits during this emergency pandemic that caused us to shut down most of the U.S. economy. The way it was set up to work was that you would get your normal unemployment check, whatever your state unemployment benefit would be, plus you would get an additional $600 a week. So if, let's say you were making $600 a week prior to the shutdown, and then your unemployment check was supposed to be $300 a week, now you'd be getting $900 a week, more than you were making when you were fully employed. Now, I know some people are worried about that. They think it's an incentive to stay home. I'm not sure that's what we need to be worried about right now. What we have to really worry about is that those benefits are coming to an end at the end of July. Now, that kind of unemployment stimulus package has kept things propped up. It's kept people paying rent that couldn't pay rent otherwise. It's also kept people making mortgage payments that couldn't make mortgage payments otherwise. When that goes away, we're going to start to see more of the damage that's been done by the shutdown of the economy. I'm afraid we're going to see it in a big way. See, one thing I've always loved about economics is that the leg bone's connected to the ankle bone. One thing impacts another. And when those stimulus checks go away and people can't keep spending the way they have been able to and can't pay their debts and their bills, it does trickle through the economy. Instead of trickle down, maybe we should call it trickle up. And as that starts to happen, it puts more pressure on companies for more layoffs. It makes it harder for lenders to extend credit. It causes creditors to restrict credit lines. It has a whole myriad of things that occur. And that's what's ahead. Now, the bailouts of big companies have already started. And the Federal Reserve here has already pumped trillions of dollars into the economy through various means and programs. There are different ways that the Federal Reserve can bail out a company. For example, they could just write them a check, right? They could also, say, agree to buy their bonds. And that's what the Fed has been doing over the last couple of months. They've been signaling to the bond market that they'll buy the bonds if the bonds default. So companies like Boeing that needed $25 billion to stay afloat simply issued bonds and borrowed the money. And the reason investors bought them is that they know the Federal Reserve will bail them out if the bond payments can't be made. Now, that's a nice way to do it, right? Because we don't have a TARP funds. We don't have people seeing us pumping money into big businesses, because that wouldn't be politically popular. So they do it through more, I don't know, subversive means. It's harder to see. But I'll tell you what, it's only the beginning. We've only just begun to see the economic damage caused by the shutdown of the U.S. economy for the last 3 months. And we're not sure how much of it's going to open and when, even today. There is so much uncertainty, but yet the stock market seems to be soaring. Why is that? Well, it's because of the acts of the Federal Reserve. It's because companies know that the government's going to bail things out. So they're willing to hang in there and wait for the check. And the Fed's not only interested in the bond market, there's already discussions about whether the Fed should be able to buy stocks. You see, the Federal Reserve has never really been able to take credit risk. Now they're talking about buying stocks, and they're already buying junk bonds. So this really is uncharted territory. But one thing we can know for sure is that the economic damage is much more severe than they thought it would be or than has been reported. And things aren't going to get better for quite some time. So as I've talked about before, if you're a business owner and you're struggling now and you're banking on things reopening in the next month or two, imagine if they don't. Where will you be in 6 months, or where would you be in a year? And if you think bankruptcy is something that could help, my advice is to talk to a bankruptcy lawyer now, before you need to. Plan beats no plan, and waiting until it's an emergency is never the best idea. If you're thinking of selling a house next year, maybe do it this year. While prices are still reasonably high, you can still get more money for your house than you will be able to next summer. And I'd say I'm 99% sure of that. So if you were thinking about selling next year, maybe think about moving that up and getting out now. Now is also the time that you want to refinance if you can. Their rates are about 3%. And if you've got a 4.5% rate, this would be the time to try to get that rate down. And if you're over 62 and have about 50% equity in your house, now is the time to look at setting up a HECM line of credit. HECM stands for Home Equity Conversion Mortgage, and it's the government's acronym for its reverse mortgage program. Now, I know a lot of people have a negative perception about reverse mortgages or the phrase reverse mortgages, but you shouldn't. You really shouldn't. There's absolutely nothing wrong with the HECM line of credit program. It's a government program. It's regulated by HUD. It is insured by the FHA, and it's a program that was made possible by Congress. So there's nothing wrong with it. The HECM line of credit gives you a line of credit that can never be canceled. So unlike a HELOC or home equity line of credit, once you set up a HECM line of credit, it'll be there for you when you need it for the rest of your life. If you have questions on this, you can always email me, Martin Andelman. I am mandelman@mac.com. You see the address on the screen. I'll be happy to answer the questions for you. And until next time, be careful out there, stay safe, and stay out of denial. Things are going to be not what they were for a while, but we'll get through this together if we just stay sane and stay focused and do the things we need to do to insulate ourselves from what's to come. So for now, this is Martin Andelman from Andelman Matters, and this has been a Andelman Matters, we call it a video podcast. Thanks for watching. Hey, I have an idea. Since I'm here, maybe if I go up and knock on the door, they'll loan me $1 trillion. You think?